Hey everybody, in this video I want to talk about ETFs versus index funds. We're going to cover which one is better for beginners, how they actually work, what their differences are, fees, trading costs, and at the very end of this video we will tell you guys which one is our favorite and why. If you're new here, welcome to our channel, where we learn and talk about all things personal finance. If you get anything at all out of this video, don't forget to like and subscribe because it really helps us out. Without further ado, let's begin. First of all, what are ETFs and index funds? These are both types of investment funds that allow you to invest your money into a basket of securities. Instead of investing into individual stocks, this provides you with a lot of benefits. But we'll get more into that later in the video. ETFs stand for Exchange Traded Fund, and index funds are simply called index funds. Now, there are many different types of ETFs and index funds, such as a broad market index fund or an international index fund or Today, we are going to focus specifically on broad market index funds and ETFs, which track a broad market benchmark such as the S&P 500. So, what is the difference between the two? Well, think of ETFs like a stock and index funds, like a mutual fund. Just like you can buy and sell stocks on the stock market, you can buy and sell an index fund, on the other hand, can only be bought and sold through a mutual fund company. Now, most brokerages offer the ability to trade but if you do have access to both, keep in mind that the fees are typically lower on each. In terms of trading costs, there are some cases when it might actually make sense to trade index funds over ETFs. For example, some mutual funds offer free trades on certain days of the month. So if you have a brokerage account that offers these promotions, it might make sense to take advantage of those promotions and buy index funds during those times. Other than that though, in most cases, it makes sense to stick with ETFs because they have lower fees and lower trading costs. Now, trading costs aren't everything that you need to worry about. It also matters whether or not your brokerage offers fractional shares. Fractional shares are a way for you to buy parts of a share of stock. This is useful if you are just starting out, because it allows you to invest smaller amounts of money. If you're interested in learning more about fractional shares, check out our video on Moomoo. We go into much greater detail in that video, and we also cover which brokers offer fractional shares. Speaking of low cost, this is another major benefit of ETFs and index funds compared to buying individual stocks. Actively managed funds charge high fees because they have fund managers who pick the stocks in the fund. ETFs and index funds are passively managed, meaning that there is no fund manager picking the stocks in the fund. Instead, they simply track an index. The benefit of this is that they have much lower fees. The reason that ETFs tend to have even lower fees than index funds is because they have more competition. Since ETFs are traded on the stock market, new ETF providers can easily come in and compete with existing ETF providers by offering a similar product at a cheaper price. On the other hand, index funds have less competition because they aren't publicly traded. There is that much competition in the space, and so there is that much pressure to keep fees low. That being said, most good index funds have pretty low fees already, and they are still a great option compared to actively managed funds. Next up is liquidity. Liquidity refers to how quickly you can turn an investment into cash without affecting its price. For example, individual stocks are quite liquid because they're easily bought and sold on the stock market. On the other hand, real estate is fairly illiquid because it takes time to sell your house, and you would likely need to list it on the market first and then wait until someone buys it. When it comes to ETFs and index funds, since ETFs are traded on the stock market, they are quite liquid and you can trade them on any day that the stock market is open. Index funds, on the other hand, can only be bought and sold at the end of the trading day, and so they are slightly less liquid than ETFs. However, if you hold index funds in your brokerage account, you can still sell them anytime during the trading day, but you won't get the actual net asset value or NAV until after the market closes. Speaking of NAV, every investment fund has a NAV, which is basically the value of the fund per share. NAV is important because it shows you the actual value of the fund, whereas the price of the fund is what you pay for it. The NAV of ETFs and index funds is calculated at the end of the trading day, and so if you buy them before the market closes, you'll have to wait until the next day to see the actual value of your shares. With ETFs, the price of the ETF will reflect a NAV because they are traded on the stock market. However, with index funds, there is a settlement process that takes place between 2 business days. So if you buy an index fund in your brokerage account, you won't actually see the NAV, or the true value of your shares, until 2 business days after you made the purchase. ETFs and index funds both provide diversification because instead of investing in just one stock, you're investing in hundreds or even thousands of stocks in one fell swoop. This helps reduce risk and volatility compared to investing in a single stock. That being said, ETFs typically have more diversification than index funds because ETFs can hold all types of securities, including stocks, bonds, commodities, and even other ETFs. On the other hand, index funds typically only hold stocks. Another benefit of ETFs and index funds is that they are both quite tax efficient. This is because they don't buy and sell a lot of securities. If you remember earlier in the video, I mentioned that index funds and ETFs are passively managed. This means that they don't actively buy and sell stocks, which means they don't trigger capital gains distributions to shareholders. That being said, ETFs can be more tax efficient than index funds, in some cases because ETFs can hold a wider variety of investments than index funds. This means that when they sell a security, they can potentially offset capital gains with losses from other types of investments. On the other hand, index funds are limited to only stocks, and so they cannot use losses from other investments to offset capital gains. Now, we've gone over a bunch of different benefits of ETFs and index funds, but now we need to ask ourselves, are there any downsides? Well, the answer is yes. Both ETFs and index funds are static, meaning once you buy an ETF or index fund, it doesn't change over time. Sure, the underlying investments within the fund may change, but the fund itself does not change. On the other hand, you can buy individual stocks and bonds, and you can tailor your portfolio exactly the way that you want it. You can buy growth stocks, value stocks, cyclical stocks, defensive stocks, and you can choose exactly the sectors that you want to invest in. With ETFs and index funds, you don't have this flexibility. If you buy an S&P 500 index fund, for example, you're simply buying an S&P 500 index fund. You cannot customize the fund at all. And this leads us to our next point. What are the best ETFs and index funds? Well, in terms of ETFs, we're big fans of the Vanguard S&P 500 ETF. This ETF tracks the S&P 500 and has a very low expense ratio of 0.03%. In terms of index funds, we're big fans of the Vanguard S&P 500 Index Fund. Admiral shares, just like the Vanguard S&P 500 ETF, this index fund also tracks the S&P 500 and has a very low expense ratio of 0.04%. Both of these investments are great options for beginners because they have very low expense ratios and they provide immediate diversification. We personally hold both of these investments in our own portfolios. And speaking of beginner investors, if you're just starting out, we recommend checking out our video on robo-advisors. A robo-advisor is a great way to start investing because it's very easy to use and it's quite affordable. With that being said, which one is better? In our opinion, we believe that index funds are slightly better than ETFs. The reason for this is because index funds tend to have slightly lower expense ratio. Now, this is only a very small difference, and for most investors, it won't really matter. However, if you're a long-term investor and you plan on holding on to your investment for decades, this small expense ratio difference will compound over time and it will add up to tens or even hundreds of thousands of dollars. Now, keep in mind, the expense ratio is only one factor that you need to consider. You also need to consider trading costs and fees. So depending on your brokerage, it might actually make more sense to go with ETFs. Thank you guys so much for watching. If you enjoyed this video, please leave us a like and subscribe because it really helps us out. Also, let us know what you think about ETFs versus index funds. Do you prefer ETFs? Thanks again for watching, and we'll see you in the next one.